Good afternoon, everybody. It's Paul here. Here we are, Monday afternoon of 22nd of July 2019, session 48 of the Admiral Markets webinar series of Mastering the 4Ms of Trading. As always, we'll begin with a quick risk disclaimer. Trading with financial instruments offered by Admiral Markets carries a high level of risk which is not suitable for all investors due to their complex nature. Before entering into client agreement or making a transaction, please make sure to read the terms and conditions of our service. Consult a specialist if necessary to ensure you understand the risks involved in trading. This presentation and the accompanying video is for information and educational purposes only. Online education materials are developed by Admiral Markets and distributed by Admiral Markets Group investment firms for a global audience. Therefore, please take into consideration that the information in this session may not be suitable for everyone. As of August 2018, the regulation within the European Union differs for retail clients and professional clients. In our presentation, we use demo trading accounts where all clients can still use a high leverage in a risk-free environment. Before opening a live trading account, please consider the differences between retail and professional trading terms. Retail clients benefit from unlimited negative balance protection. Professional clients at Admiral Markets UK receive a compensation of account deficits with the maximum payout of £50,000 sterling as per our negative balance protection policy. We believe that Admiral Markets offer a very competitive offering for those of you looking for a brokerage to trade with. If you look at the most popular trading instruments in terms of DAX 30 and Euro Dollar, you can see that we have very competitive spreads, which are always getting tighter. And also we offer the MetaTrader platform with both the MT4 and MT5 version, with also the Admiral Markets Supreme Edition plugin. And Admiral Markets is a truly global brokerage that is regulated in several entities across the globe. And if you contact your account representative, they will be happy to guide you to open an account with the most suitable entity for yourself. So as always, ladies and gentlemen, it's my job to educate you about the 4Ms of trading so that I hope you can go away and analyze any market and be ready to trade it, and also help you raise your self-awareness about managing risk and managing yourself. For yourselves, I appreciate we always have a little bit of a time limitation, which means that we can't always go into topics with the amount of breadth and depth that some people would like, but we always try and focus on tools that you can utilize tomorrow in your own trading business. And as always, what we said from the first session is that we are all about mastering the 4Ms of trading, and what everybody's looking for is to be able to operate in that sweet spot where they're in mastering markets, method, money, and myself. And throughout all of this series, that's what we've been looking at covering. And what we talked about was that we had sessions on as we come towards the last four of the Mastering the 4M sessions. We would look at markets, method, money, and myself. Today is July 22nd, and what we're going to be looking at is a recap of the money management section, and that's what we're looking at today. Because the whole idea was that, during these last few recap sessions, we could draw our 4M learning points from this series. We'd be looking at, how we've looked at to prepare for our trading day, how we follow our 10-step plan, how we do our market analysis, what we have to do to choose our entry, how we manage our risk, which is what we're going to recap today. And we'll also look at how we record and review our trades and how we manage our trading performance. So if you remember from our 10th step, we talked about, step 6 is all about risk, okay? It's all about understanding risk and managing it. And that's what we're going to focus on covering today. And, as Mr. Soros says, the secret behind success is to embrace risk, not to avoid it. But, we appreciate we need to really understand and be able to define, what actually risk is, what it actually means to us as a trader, and also the sort of variations upon it. And we'll just recap this here today. If you want to go into more detail, you can go back and find session 20 and I think session 21, which are on the Admiral Markets YouTube channel and will also be in the Admiral Markets Global Facebook page where you'll be able to find the previous recordings, and you can find where we go into these elements in more detail. Today is about recap, okay? It's about being able to help you with these last couple of sessions, just recap what we've covered and make sure that you truly understand the concepts that we've been discussing. So, what we talked about in terms of, risk and management, money management, is that you're a trader, ladies and gentlemen. So it's your job to take risks. That's part of the sort of part and parcel of life as a trader. So therefore, it becomes your job to manage risk. And the better you become at managing risk, the quicker your progression will be to profitable trader. And that is absolutely 100% true. So, what we'll talk about, what are we going to cover here is, all those elements that help you become quicker and better at managing risk. Because if you're not managing risk, you will always have struggles as a trader. You'll always have challenges. And what we're trying to do here is educate you to be able to understand the different variations of risk and how you can manage and utilize it within your own trading business. And remember, if you want a very, very simple sort of the KISS, keep it simple definition, is that risk management involves essentially knowing how much you're willing to risk and how much you are looking to gain. And that's at the most sort of very basic element, simple of it, but we will go into a few more details in that as we go through our session. And if you want to break it down further, risk management is about, the management of open trading positions to avoid large losses occurring. And money management is about sort of setting the correct position sizes in relation to your overall portfolio and cash position. And hopefully that will become a little bit more clear as we go through our recap session today. So another great thing that Mr. Soros said there is that my principle is to survive first and make money afterwards, and that's absolutely true for all traders. Although very often we see them actually trying to do the exact opposite. They will actually sort of reach out to try and make money as fast as possible, but the flip side of that is that they don't protect themselves, and that can get themselves in a little bit of trouble. By the end of this session, that should not be an issue or a challenge for yourselves. You should be able to definitely sort of survive first. And that really sort of leads us into the kind of our first risk management rule, which was rule 1, which is always to live to fight another day as a trader. You don't want to be like that fighter pilot here in the gun sights. He's going to be shot down there, okay, by his enemy. And as traders, we don't want you to be shot down by your enemy. Okay, what we want you to do is to be able to always live to fight another day. If you can do that, well then, regardless of what the market happens, what happens in markets, or regardless of what, if any, mistakes you've made, you'll be able to learn from it, live to fight another day, and that will take you forward. And if you remember, our second rule was also, never ever find yourself in a trade without an exit plan. And what we're trying to do here is trying to, help traders avoid just taking, knee-jerk, impulsive trades. It's about having, planning your trade, trading your plan, managing your risk. Because if you do all 3 of those things, then you actually set yourself up to effectively be, that trade to be successful, regardless of the outcome of the trade. If you're planning your trade, trading your plan, managing your risk, that is crucially important for every single trader. So, if we're looking at rule 2 and we want to understand, where are the exits, as I said, we want to know where the exit is before the trade is placed. Well, we have 2 types of exits. One, where we get out when we're wrong, and also secondly, where we get out when we're fortunate enough to be right. And that's what we're going to focus on here, where we get out when we're wrong, because that's the first element. That's the sort of key part that we want to be sort of taking on board. Curtis Faith, a friend of mine and a super trader, okay, always had this great quote that we thought that each trade possibly could be a winner, but that most probably would be a loser. And that's part about having the mindset, okay? If you have the mindset that you enter with your trade is probably be a loser, that means you're more likely to sort of focus on managing risk and taking the necessary precautions. And here's another great quote from John Carter in his book, Mastering the Trade. Amateur traders focus on how much money they can make on each trade. Professional traders focusing on limiting risk and protecting capital. Professionals always take money away from amateurs. I think that's a great quote, and I always very clear to sort of define that. Some people might say, well, if you're an amateur trader, that means you're a retail trader working for yourself, or a professional trader is perhaps somebody working for an institution. That's not necessarily always the case. I would define amateur traders and professional traders as the definition of their attitude. Okay, and a professional trader focuses on limiting risk and protecting capital. And it doesn't matter whether you're trading a $200 million book or a £2,000 trading account. Okay, professional traders focusing on limiting risk and protecting capital, and that is unbelievably important. So, what we've talked about in the past is that, understanding your own risk profile and how it's actually, a very personal thing, all right? However, it's a very personal thing. Some of us are more risk averse than others. Some of us are very aggressive, okay? It's about understanding who you are and what your own particular risk profile is. However, in this particular case, for our own investments, what we're looking at is, we're trying to keep it very simple and very straightforward, okay? We never risk more than 1% of our capital on any single trade, right? And I always repeat it because it is that important. We never risk more than 1% of capital on any single trade. And that becomes just unbelievably important, especially when you're starting out as a trader, because it allows you, all right, it allows you to sort of also stay true to rule number one. And if you remember what rule number one was, that we always live to fight another day. And so this means that if you're only ever risking 1% of capital on a single trade, well, then actually your ability to sort of stay and live to fight another day and learn and improve as a trader increases exponentially. So what does that actually mean? How do we actually do that? If you remember, this is what we covered in session 20. So we talked about, let's say we have a trading account of £10,000. It might be €10,000. It might be $10,000. It could be another global currency based upon wherever in the world you're watching this. But just for the sake of our exercises, bear with me. We're just saying that we've got a trading account of £10,000, and we will only risk 1% of our trading account on any single trade. So how much are we actually risking on our trade? Well, hopefully 1% of £10,000, you're able to work out that that is £100. That doesn't mean we're trading at £100 a point, all right? That means we are risking £100 for the entire trade. We will never lose more than £100 on that particular trade if we're trading 1% of a £10,000 account. That is what we know as our capital risk. That is the capital we have, and that is how much we're going to risk in the market. So if we have another little an example here, let's say we have a trading account much smaller. We've got a trading account of £1,000. Okay. Once again, it could be €1,000, it could be $1,000. Depends on where you are in the world watching this. We're only going to risk 1% of our trading account on a trade. How much are we risking? That's right, 1% of £1,000 is £10. Okay, that doesn't mean we're trading at £10 a point. It means that we're risking £10 for the entire trade. That is our capital risk. Okay, that's how much capital we're going to put at risk in the market for that particular one trade. Now we have to work out how much to trade per point. Okay, this is what we call position sizing. We know what our capital risk is. It's 1% of our trading account, whatever our trading account may be. Now we have to work out the other side of the kind of equation so that we can do some proper position sizing. So we have, in this example, we have a trading account of £10,000. We know we're only going to have capital risk of 1% of our account on a trade. So we know that 1% of our £10,000 trading account is £100. In this particular example, let's say we're trading the pound against the United States dollar. We're looking to be a buyer, so our long entry is at 129.00. Our stop loss, okay, which we'll touch on in a moment, our stop loss, the point at which we no longer want to be in that trade, is beneath our trade at 128.50. So then the question becomes, how much points of trade risk do we have? How many points of trade risk do we have? Well, hopefully you can work that out to realize that we have 50 points of trade risk. That's what we're trying to work out and understand. So if we're going to risk £100 of capital risk and our trade risk is 50 points, how many pounds per point can we trade at in this particular example? Pretty simple one to begin with. I appreciate it's a Monday, so we want to make it nice and gentle to begin with. So in that particular case, hopefully we can recognize by dividing our capital risk by our trade risk that we're actually able to recognize that we can trade at £2 per point. So, in another example, we've got a trading account of £10,000. We're only going to risk 1% of our account on a trade. We're risking £100, so we know that. In this particular example, let's say our long entry, we're going to be long buying the euro against the US dollar. We know that our entry level is at 136.00, and our stop loss, the point at which we no longer want to be in the trade, is at 135.80. So once again, how many points of trade risk do we have? That's right, we've got 20 points of trade risk, okay? The number of points is the difference between our entry and where we want to be out of our trade on our stop loss. So if we're going to risk £100 and our risk is 20 points, how many pounds per point can we actually trade at? So once again, it's a simple sum of dividing the capital risk by our trade risk. That gives us a point of £5 per point. And that's exactly what we're doing, okay? So that means that if our trade goes against us, 20 points, okay, and we hit our stop loss, the 20 points at £5 a point, that means we will lose £100, which is only 1% of our account on our trade. So we have made sure that we have, engaged in proper money management and risk management. So as always, if there are always extra, golden rules. Here's a golden rule as always is to cut your losses and ride your winners, which is, it's very easy to say, all right, but what you find is actually most new traders do just the opposite of this rule. What they do is they hate to take a loss, and what they do is they snatch at any particular profits that they might have in a trade. Part of that is about recognizing, as I said at the start, plan your trade your plan so that you're able to cut your losses and ride your winners. And if you want to know more about that or be confirmed for that, you can always read the book Market Wizards, a very well-known book for traders. And there's a interview with Ed Sequoia, who talks about the elements of good trading on number 1, cutting losses, number 2, cutting losses, number 3, cutting losses. If you can follow these 3 rules, you may have a chance. And he's being maybe a little bit flip, but that is actually absolutely true, okay? This is all part of managing risk. If you can do this managing risk well, it gives you the opportunity to go on to become a very good trader. So, what we also look at is, we always look to protect ourselves at all times, okay? And in trading, we do this by the use of a protective stop loss. Because trading without stop loss ignores the potential damage that market could do to you psychologically, emotionally, and also financially. Because what actually has to happen is protecting yourself at all times and in every trade needs to become a subconscious habit. To protect yourself at all times, and if you take a financial loss, you don't take it personally. And it's easier to do that if you're only ever risking 1% of your account balance on any one trade. Trading without protective stop loss orders is outright exposure to financial self-destruction. And that's what we're actually definitely sort of just trying to avoid. And there are, of course, multiple types of stop losses that people particularly use. So invariably, we see people using things like technical analysis stops, okay, placing them more on the chart. They might use financial stops in terms of how a set number of money that they particularly wish to lose. A discretionary stop based upon how they view the market, which is not a really very good way to act for a complete new trader. You might have a psychological stop, where there's a level at which they can take the pain no longer. And once again, that's not really something for a new trader to look at. Some traders will have volatility stops, so basically they'll work out what the average range is for that particular time frame upon which they are trading, and then they may have a rule, let's say, that they just might have a volatility stop of 2 times the average range for that time period, and their stop loss always goes away there. Other people, and particularly investors, might use percent stops, so they're always looking having a number maybe somewhere between 10 and 20% between from the recent highs. And other traders might actually use time-based stops, namely that if the trade isn't doing what they thought it would within a certain window of time, then they will look to kill that trade. What we've done is focus on technical analysis stops, but we also cover psychological stops, okay, common sense stop losses that's required. So, in terms of, technical analysis stop, it's a case of, in this case, we had, this was on Google. So, we had a weekly bullish flag pattern there, and, we're using the lines of support resistance, okay, as where we could place our stop. Basically, once we were breaking out, our stop could be at the other side. Let's just draw the tool here. That's why I don't want to put the tool here. Our stop loss could be here, right? Okay, beneath the actual sort of the lower support line of the flag, or some traders may have wanted to use the fractal, okay, that we're here, and have their stop loss just placed beneath there. There are lots of different simple technical analysis ways that you can utilize your stop behind something like the fractals, or a moving average, or beneath the recent low or high, or behind the recent level of support resistance. It's about finding just a simple way within there that you can utilize and follow on every single one of your trades. So, when it comes to technical stop losses, okay, people use lots of different types of technical stops. Maybe they put it behind pivots, okay. If you're an intraday trader where you have the pivots placed upon your charts, you might stick them behind a pivot. Or, as we said there, behind a level of support resistance, which might be a horizontal level of support resistance, or might be as part of a bigger, greater chart pattern. Could be behind the moving average, especially if you're in a strong trend, or it might be beyond the other side of the previous day's highs or lows. Some people like to use a trailing stop, but even once again, that's using normally a sort of a technical analysis-based rule for movement. You may need to sort of identify where congestion areas and look to place your stop behind that. Or you might use an actual technical indicator, something like PSAR, parabolic support resistance, which prints dots on the chart, and that actually gives you an opportunity to sort of have a simple, consistent way to place and move your stop losses. As I said, we also have psychological stop losses, which is kind of a bigger picture. When it's certain times where you're nowhere near 100% in your trading, ladies and gentlemen, you should be flat. Okay, you should be flat, pure and simple. So there's occasions like if you're going through like a divorce or a separation, or you've had the death of a significant person, or a new child or a new baby has entered your life. If you're moving home or office, that can be equally traumatic. Or if you're feeling psychologically exhausted or burnt out. Or maybe when you're so excited about a position that you feel like doubling up your position. Or maybe when you're on a vacation, okay? When you're on holiday, go on holiday. Or if, like me last week, when you're on a business trip and you cannot follow the market. So when I go to visit clients, okay, on business trips, and I have a few days away, there I don't trade at all, because, I know that I can't give it enough focus and energy that I wish to, and also it becomes a distraction from my meetings with my clients, and that's not fair. So I found that over the years, it's simpler for me to just not trade when I'm doing a business trip. Or, if I'm feeling a little bit exhausted or burnt out, when that happens, just take a few days off, okay? Certainly if, you're having the either the sort of, the death of a significant person, or you've had a new child, or maybe there's some illness in your family, okay, I can assure you the best thing to do is to actually take a little bit of time off. Don't try to trade your way through it, because what will happen is your emotions will wreak havoc with you, and you'll end up sort of trading poorly. So, just to in review, we talked about preparing your trade. Okay, that's what we're looking for. And what we're always looking to do is to quantify our risk. And that becomes much easier, right, when we know what our stop loss is, all right? We know where we're going to get in and we know where our exits are. Never enter a trade without an exit. You know where your exit is when you're wrong, where your stop loss is. That's your entry price versus your exit price if you're wrong. That distance, okay, in terms of points and between capital, you'll find that professional traders will trade that, will define that trade risk as R, okay, as a unit of R, it's a unit of risk. The reason they do that is because it takes the emotions out of the sort of the money side of it for a trader. What we're also looking to do is to quantify our reward, all right, where we take our profit, which is our entry price versus our exit price if we're right in our trade. And that allows us to calculate our risk to reward ratio. That's you'll hear lots of traders talk about that and how they define the risk to reward ratio, and that we will place, we will talk about next week. So, this was an example of a trade here, okay? And so, I knew where I was getting in, I knew where my entry was, I knew where I wanted to be out of the trade if I was wrong, and I knew that my target was just in front of this particular level of horizontal resistance. So, I knew where my entry was, I knew where my exit was if I was wrong, and where my exit was if I was right. So that's, as I said, quantify your trade risk. Once I know where my entry was and where my stop loss was, I knew how many points of trade risk I was going to have in play. I also want to work out what my reward is, okay, in terms of, where's my opportunity to take profit. And that we're really looking at is, as I said, that's your entry price versus your exit price if you're right at the target. And that allows you to operate and understand your reward to risk. And that allows you to determine whether it is actually a viable and valid trade setup. And then what we're looking to do is always, once we know that, we've got our trade risk divided by our capital risk equals our position size. That allows us to ensure that we're only ever risking more, no more than 1% of our trading capital on any single trade. And that allows us to fulfill rule 1, which is always to live to fight another day. So here's a few little simple sort of kind of final 10-man money management rules, namely, number 1, limit your losses. 2, let your profits run where possible. That can be in both either having a target or having an asymmetric reward to risk ratio. Keep position sizes within reason, all right? 1% of account as a general rule of thumb. Know what your risk to reward ratio is so that you make sure that you've got an asymmetric ratio. Always ensure you're adequately capitalized. Never, ever trade without a stop loss. Never, ever add to a losing position thinking that will help you. Never move your stop against you. You have a rule that you can only move your stop for you as the trade moves in your way. Always make sure to learn from your mistakes, and the best way to do that is to keep yourself a good trading journal. And have a maximum loss or retracement in profits. And what we mean by that is that, having just looking at a drawdown from peak highs, that can actually just give a little bit of a signal that you might wish to sort of take a bit of time off or to take a little bit of a profit from your trading endeavors. So, when we talked about step 6 in terms of risk management money management is one of the simpler topics to grasp, but it seems to be very hard for many traders to follow it. You can overcome a lot of bad luck with proper money management techniques. That allows you to stay in the game and develop the skills and experience to profit from the markets. And if you only take 2 things from this whole of today and the whole series, in fact, never risk more than 1% on a trade, never ever trade without a stop loss. That will actually help. That will always help make sure that you can, make sure you meet rule 1, which is to never, always live to fight another day. So just to finish, remember, we've always got our nice 10 steps to follow. Step 1, define levels of support resistance. Whenever you open a chart, make sure you're doing that. Step 2, define if there is a trend. Maybe there is, maybe there isn't. That's absolutely fine. Step 3, see how price reacts at key support and resistance levels. because at step 4, you should be looking to see, are the price action signals at those support and resistance levels? That might be your trigger into a trade. Step 5, is it part of a bigger chart pattern? Step 6, define risk. Define your risk, accept it, and stick to it. That's what we've recapped today. Step 7 is all about rewards, okay? Targets or trading, know your exit when you're right. Step 8 is about keeping scrupulous records. Step 9 is about reviewing, improving your performance by debriefing your trades. Step 10 is all about repeating, because consistency and discipline are key as a trader. So remember, ladies and gentlemen, we're always looking to manage the 4Ms of trading, namely markets, method, money, and myself. Ask yourself that quick question for yourself right this moment. Are they all in alignment in your trading business presently? If not, then do not expect outsized returns. Constantly monitor those 4 areas and constantly check that you're learning and growing and able to master the 4Ms of trading. As always, it's if you're watching this on demand and you have any questions, then feel free to get in touch with us. We'd love to hear from you. You can, as always, call us on that London number 02035140756. You can drop us an email at hello@admiralmarkets.com. Look at us on the YouTube page at youtube.com/Admiral Markets, or check us out on Facebook, facebook.com/Admiral Markets Global. I hope you found that useful. I hope you found that a useful recap on risk management and money management. I implore upon you to sort of learn and also to stick to those rules, okay, about risk and money management. They will help you enormously. And I look forward to seeing you for the next session, session 49, which will be our final session of Mastering the 4Ms of Trading, before we start in the new Trading Spotlight series, which you'll be undoubtedly be aware of, that will be beginning on August 5th of this year. As always, I wish you the very best of success in your own trading, ladies and gentlemen, and I look forward to speaking to you soon. Trade well.